The speed at which a stock price increases can vary significantly depending on several factors, both internal and external to the company. The pace at which a stock's price rises is a reflection of investor sentiment, market conditions, and the company's fundamentals. Below is a detailed breakdown of the factors that influence how quickly a stock price can increase. 1. Market sentiment and news. One of the most immediate drivers of stock price movement is market sentiment, which is often influenced by external news, including economic reports, geopolitical events, or company-specific developments. When there is positive news about a company, such as strong earnings, new product launches, or favorable government policies, investors may react quickly, causing the stock price to rise sharply. Earnings reports. If a company reports earnings that surpass expectations, it can lead to a quick price increase as investors rush to buy shares. Mergers and acquisitions, M&A. Announcements of mergers, acquisitions, or partnerships often result in rapid stock price increases, especially if investors believe the deal will add value to the company. Market-wide events, broader market movements, such as changes in interest rates or central bank policies, can also affect the pace at which stocks move. For example, if a central bank cuts interest rates, it may stimulate economic activity and push stock prices higher. 2. Volume of trading. The speed of a stock price increase is closely linked to the trading volume. Higher volumes indicate greater interest from investors and traders, which can accelerate price movements. A sudden surge in trading volume often correlates with a quick price increase as more buy orders flood the market. Liquidity. Stocks that have higher liquidity, larger volumes traded, tend to experience smoother and quicker price movements, as there are enough buyers and sellers to handle large trades without causing a lot of price slippage. Volume spikes. A significant increase in volume, such as during an earnings report or the announcement of a major event, can quickly drive up stock prices as traders and investors rush to act on the news. 3. Investor behavior and speculation. The psychology of investors plays a critical role in the speed of a stock's price increase. Speculation and herd behavior can cause prices to increase rapidly, particularly when investors believe a stock will continue rising, prompting more buying activity. FOMO, fear of missing out. A classic example is when a stock starts to rise rapidly and investors fear missing out on potential profits. This FOMO can cause a rapid acceleration in buying as more investors jump in, further driving the price up. Momentum trading. Some investors engage in momentum trading, buying stocks that are already rising in price, betting that the trend will continue. This can create a feedback loop where the stock price continues to rise rapidly as more investors buy in. 4. Supply and demand dynamics. The basic principle of supply and demand is a crucial factor in how quickly a stock price can increase. If demand for a stock outstrips its supply, more people want to buy than sell, the price will rise. The speed of this increase depends on how quickly the demand surges and whether there is enough supply to meet that demand. Limited supply. If a stock has a relatively low float, the number of shares available for trading, even small increases in demand can lead to rapid price increases. This is because there are fewer shares available for investors to buy, making each share more valuable. Short squeeze. A short squeeze occurs when a heavily shorted stock suddenly experiences a rapid price increase, forcing short sellers to buy shares to cover their positions. This can cause the stock price to rise sharply in a very short period, as seen in the GameStop saga of 2021. 5. Market liquidity and volatility. The liquidity of a stock plays a significant role in determining how quickly its price can increase. Stocks with lower liquidity tend to experience more volatile price movements, as fewer shares are available for trade. This can result in more dramatic increases in price when there is a sudden influx of demand. Volatility. Highly volatile stocks can see rapid price changes, both increases and decreases. Volatility is often driven by external events, such as earnings reports, product announcements, or economic data releases that lead to large price swings. Circuit breakers. In extreme cases, markets have built-in mechanisms, like circuit breakers, to prevent prices from moving too quickly. These measures temporarily halt trading if a stock or index experiences a sudden and dramatic price increase or decrease. This helps to prevent panic buying or selling and allows investors time to reassess market conditions. 6. Institutional buying and fund inflows. Institutional investors, such as mutual funds, pension funds, and hedge funds, can influence the speed at which a stock price increases. When large institutions decide to buy a stock, it can quickly drive up the price due to the sheer size of their trades. Large-scale purchases. Institutions often buy large blocks of stock, which can lead to immediate price increases. Because they manage substantial amounts of capital, their trades can overwhelm the market, pushing prices higher very quickly. Index inclusion. When a stock is added to a major index like the Sensex or Nifty 50, institutional investors often have to buy the stock to match their index weight. This can result in a rapid increase in the stock price due to large-scale buying. 7. Company fundamentals and growth potential. The underlying fundamentals of a company, such as revenue growth, profitability, management, and industry position, can also influence how quickly a stock price increases. If a company demonstrates strong financial health or growth prospects, its stock may see a gradual and sustained increase in price over time. Strong earnings growth. Companies that demonstrate consistent and strong earnings growth, particularly in sectors experiencing significant expansion, tend to see their stock prices rise more steadily and at a faster pace. Market positioning. Companies in emerging sectors or those with innovative products may experience rapid stock price increases as investors anticipate strong future returns. For example, stocks in the technology or renewable energy sectors have seen sharp increases as investors bet on future growth. 8. Macroeconomic conditions. Broader economic conditions, such as interest rates, inflation, and GDP growth, can also impact the speed at which stocks rise. In favorable economic conditions, stocks generally tend to increase in price, as investors have confidence in the broader market and economy. Interest rates. Low interest rates, for example, make borrowing cheaper and can increase investment in equities. When central banks lower interest rates, stocks often see a rise in price as investors seek better returns in the equity markets rather than low-yielding fixed-income assets. Economic growth. A growing economy often leads to higher corporate profits, which can boost investor confidence and lead to rapid stock